Today, Nvidia is worth more than the GDP of all but the USA and China.
Whether a $5 trillion valuation is the right one for the company, I doubt it. It's priced for perfection.
Meta and Microsoft shares have fallen in after-hours trading after the tech giants disclosed huge AI spending plans.
$80 billion on AI infrastructure in the last quarter alone. I mean, the numbers are just off the chart.
Trump's summit with President Xi this week. This is a one-year trade truce.
This is a really important staging post on the path to a longer-term resolution. China and the US are going to be economic, geopolitical rivals for as long as I'm breathing, and beyond.
Lloyd's has got more branch closures coming up next month. If you look at the share prices, they're up 100%.
All the things that you want to like about a bank, you can see in the results of Barclays, NatWest and Lloyd's, and indeed HSBC this week. And they look to me like fully sort of recovered businesses.
Which sector within UK equities would you look most closely at?
It's a bit of a toss-up. Can I have two?
If you had to choose one word to describe financial markets in 2025, what would that word be? Neil, last month you said that the concentration in the Magnificent Seven was becoming potentially dangerous. And now today, Nvidia alone is worth more than the GDP of all but the USA and China. Does that reinforce your point or challenge it?
Nvidia, to me, is the most obvious picks and shovels supplier to the AI industrial revolution. And it clearly has had an amazing year. It's doing incredibly well because the chips that it makes and develops are at the heart of every single piece of Western world and indeed Chinese AI infrastructure. Whether a $5 trillion valuation is the right one for the company, I don't really know. I doubt it, to be honest. It's hard to be critical, but the valuation is one that's dependent on that dominant position, unrivaled position, remaining in place for many years to come, and I think that's unrealistic. Now, of course, we know that Nvidia's market opportunity in China is going to be abated significantly, even after the apparently very good summit that was between President Xi and Trump. In all likelihood, China is a market that will not grow for Nvidia. Clearly, it's the largest, most profitable and most obvious beneficiary of the AI industrial revolution. I said that at the start of the year, and I would still say that today. It's effectively a monopolist in some respects, or near monopolist. My guess is that going forward, that is not going to be the case forever.
So do you think the major players in the AI space, so Google, Meta, Microsoft, do you think they will try to develop their own competitors?
Yes, they already are. Google in particular is leading in that respect. Whether they'll be successful and whether they will rival the lead that Nvidia has, I don't yet know. But what we do already know is that the models that they're developing in China, be it Baidu or Alibaba or indeed DeepSeek, all appear to be developed with technology that isn't entirely dependent on Nvidia chips. That's an important development.
You've said that valuation always wins. How long can it keep defying gravity?
Well, I'm not saying it's defying gravity now. Okay, in my view, it's overvalued. I wouldn't hold Nvidia in a portfolio now. I think there are better opportunities, other equities in other parts of the world equity market. But that doesn't mean that it's about to fall off a cliff. There is a temptation to portray everything as a sort of binary outcome. It's either brilliant or it's awful. Actually, Nvidia could actually spend the next 20 years being a half-decent, not bad investment. It just isn't going to produce the sort of returns going forward that it has in the past.
Well, of course, so Meta's results came out yesterday, and their results triggered a bit of a sell-off in the stock.
They did, and I think that the disparity, for example, between what Google said and what happened to Google's share price and what happened to Meta's and Microsoft's is, in a way, is interesting. In general, all three companies produced pretty good numbers, but there were things that concerned investors that caused the fall, the 8% or so fall and the 3% fall in Microsoft. The thing that worried investors most were the upgrades to CapEx spend. Microsoft upped its numbers, and Meta said that next year growth in AI investment would accelerate on growth this year. The three companies that reported, Microsoft, Alphabet, and Meta spent nearly $80 billion on AI infrastructure spend in the last quarter alone. I mean, the numbers are just off the charts. It's really, really hard to get your head around it. And those concerns are really focused on just the fear of the scale of investment that is being envisaged, and in particular with Meta, because it doesn't have the cloud computing revenues that Microsoft and Alphabet enjoy. There were reasons why Alphabet share price went up. They announced that they had 650 million customers for their AI solution. Their cloud computing revenue grew very strongly, I think well over 30% in the quarter. These were the sort of straws in the wind that I think the investors in the US liked. Microsoft growth wasn't really good enough to satisfy the recent rise in the share price.
I wanted to just come back to one thing about Meta's results and the sell-off that it triggers. An 8% drop overnight is, potentially worrying if you're a shareholder. One of the things that I thought was interesting is if you actually look past the headlines, yes, their earnings per share was significantly lower than analysts expected, but the reason that happened is because of a one-off $15 billion tax charge as a result of Trump's One Big Beautiful Bill. And if you'd taken out that tax charge, they would have actually beaten the analyst expectations. So is this just an example of where markets perhaps lose the ability to separate the signal from the noise?
Look, I think there's an element of that. My read of what the analyst was saying is that the tax charge was sort of discounted. I mean, in the normal course of events, those sorts of things, which are very one-off in nature, tend not to be that influential. The thing that concerned investors was the CapEx commitment that Meta made,
right,
combined with the fact that its social media focus doesn't provide the level of sort of security that, say, Microsoft and Google have with their giant cloud computing revenues. All of them announced higher CapEx. The most dramatic was Meta, but I think the focus of the concern was, well, oh my God, if this doesn't work out, how will Meta insulate its shareholders from the disappointment? The sort of more general view was, well, Alphabet, Google, and Microsoft have these enormous and growing cloud computing revenues, which if their models don't work out, if they can't get an economic return on deploying their AI models, then they can always generate additional cloud computing revenue from the infrastructure that they've built. That doesn't appear to be such an easy option for Meta. And I think that was at the heart of what caused the share price to wobble last night.
Meta, on the other hand, seemed to be looking more at consumer tech with their foray into smart glasses and glasses with cameras and
and the losses in that business were huge. There's a lot of they've spent a lot of money. There's a lot of R&D gone into the development of these products. And I think there is some concern, and maybe a greater level of concern, because its metaverse investments really didn't play out in the way that was claimed. When they first talked about that potential growth engine, and indeed changed their name, of course, to Meta.
Neil, let's talk about geopolitics. Huge, potentially world-changing discussions happening in Asia this week with Trump's summits, both in Japan and in South Korea. But I think most notably with President Xi this week, has the potential to reshape the sort of investment landscape. This is a one-year trade truce, I think, that we have between the two countries. Can you tell us what you think of it and perhaps what we should take away from it?
What we've got here is as you say, a one-year truce. But I think this was a sort of a high-profile and a very important meeting. What I think this amounts to is a really important staging post, if you like, on a path to a more longer term resolution of these trading issues. I think the direction of travel is now much more positive. Now, of course, they could fall out again over something. I mean, Trump came away, effusive about the discussions he'd had with President Xi. He talked about a score of 12 out of 10 in terms of the outcome. Now, he's a politician, of course, that's very Trumpian in a way. But I think even he wouldn't have been that effusive if there'd been any shadow of doubt that this wouldn't lead to a more permanent solution. The two teams have got a lot of work to do from now to sort of cement what is now a sort of an important truce into some longer lasting, all-encompassing trade deal.
Now, the strategies on the W 4.0 platform, particularly Unstoppable Trends on your top 40, have a reasonable amount of Chinese stocks or Chinese companies in those strategies. What does this mean for those companies? Is this a positive development?
Yes, in so much as if it hadn't gone well, I think it would, and that would have been reflected in quite a lot of investor disappointment. It significantly reduces a risk that people were very worried about. I mean, you might think, we might argue, well, they weren't that worried. Look where markets are. I think that there's a certain amount of traveling and arriving. I mean, markets haven't been that enthusiastic since the deal was done, since Trump flew away saying 12 out of 10. Markets have actually gone down.
Is that a result of pretty much everything that was expected happened, and therefore everything was priced in?
There's a phrase in markets, traveling and arriving. The journey to an event tends to see markets discount the outcome of that event, whether it's good or bad.
I've not heard that one.
Yeah. So we traveled well to the summit, and the summit itself delivered what I think most people had hoped. And there was a bit of a market yawn, on the outcome.
So more of a yawn, less of a sigh of relief.
Yeah, I look. There's no doubt that if things had gone badly, that would have been very bad news, I think. So we have removed a big risk factor. The basis now is, I think, moving forward is that we should assume that the two sides work hard to negotiate something that's longer lasting, more permanent.
Okay, so sounds like it doesn't change much of the investment landscape for the market. Does it change anything in the investment picture for you?
Not for me, but remember the starting point was at the end of last year, most global investment banks were saying that China was uninvestable. Institutional investors, tend to move more slowly, but with this significant risk factor significantly reduced, I think the relative attractions of China have increased. So I would take this as positive for Chinese equity, at least international interest in leading Chinese equities. Of course, there will be conflicts going forward. It's very clear. China and the US are going to be economic, geopolitical rivals for as long as I'm breathing, and beyond. I
know Nvidia are probably planning on trying to ask President Trump for some extra leeway on selling chips to China, but do you think that's an outside chance?
I don't think China's going to reverse its policy. I think there might be a market for some dumbed down chips in it sounds terribly rude, doesn't it? But dumbed down chips in China. But
not the sort of
no
A-list chips.
No, I don't see that reversing. Doesn't suit US, doesn't suit China. China wants to grow its own chip industry, wants to become self-reliant, really, in that leading chip technology. And it won't do that if it becomes, dependent on Nvidia chips.
Bring it back to a couple of UK stocks that often get talked about together. One has had pretty strong year, and the other one seems to be treading water. That's Next and M&S. What do you make of these two, and what should we be thinking about them?
Next and M&S tend to get bundled together because they are both leading clothing retailers in the UK. But that's sort of where the similarity ends. I mean, there are similarities, but there are also very fundamental differences. Next is an international business. I mean, for example, in their Q3 results, which came out this week, which were excellent, by the way, Top line revenues were nearly twice as good as the consensus was expecting, with growth in excess of 10%. The engine of growth for that sales was their international business, their international online business, which grew at something like 35%. M&S doesn't have that. M&S is one of the most successful UK food retailers and is growing its market share, and its food business is doing really, really well. Next trades on a much higher rating than M&S. That reflects, I think, investors' view that its growth prospects are probably better. And certainly from its international business, you would have to conclude that they were. But that doesn't mean M&S isn't a really attractive and strongly performing business. It's had a difficult year this year. Remember, it suffered quite badly from a pretty major cyber attack, and that really did affect its summer trading. But I think those problems are now behind the business. But aside from that, M&S is a recovery story in many respects, in my view. It's for decades M&S has been underperforming as a core UK retail business. It's really struggled, as many retailers have, with the shift to online. All those things that it's had to grapple with, of course, and it's not been easy. But I think M&S is through the majority of those major challenges and is beginning to sort of find its stride again, and is performing much better both in its clothing business and in its food business. There are lots and lots of indicators of a business that is now putting behind it, in a way, 2 decades or more of underperformance. So, I think both are really interesting, different attractions.
So M&S might be an example of a bargain that you can still find on the high street.
Yeah.
Speaking of the high street, Lloyd's has got more branch closures coming up next month. Is that symbolic of something we should read into Lloyd's and its future, or is this just an example of modernization?
Look, I think you're right, John. It's a product of the modernization of retail banking business. Its branch network is being downsized as technology improves, as its online banking offer gets better and more comprehensive. All banks are doing the same thing, not least because they have to compete with online only offers. So it's just part and parcel of the evolution of these banking businesses, these traditional banking businesses. Some of their customers are going to be pretty annoyed about branch closures, but it's an inevitability of how these businesses are evolving. But they've obviously had to learn fast from the banking startups that have developed in the last 10 years. And I think they're slowly getting their act together. And the reality is that Lloyds is actually performing, as are other domestic banks, performing very well as a business.
Let's talk about the UK banking sector, because it's a sector that features heavily in the UK-focused strategies. What is it that's caused those banks to perform so well? Because, I mean, if you look at the share prices, they're up 100% over the last 12 months.
Yeah, look, I think to put this performance into context and to understand what's going on, you have to appreciate the history, really, of the UK banking sector. A little over 10 years ago, more than 10 years ago, 15 years ago now, the UK banking sector went through an existential crisis. It was very, very ugly. It's taken a very long time for the banks to repair themselves and for the industry to sort of recover and emerge from that existential crisis. And the valuations of the banks reflected a sort of a legacy perspective. And I think that legacy lived on in the share prices of the banks even after their balance sheets had been substantially repaired and their profitability was rising and their returns were increasing. So I think to understand where the banks are now, you have to sort of appreciate where they've come from. Where are we now? I think the banks are going through a sort of a very benign period, really. All the things that you want to like about a bank you can see in the results of Barclays, NatWest, and Lloyds, and indeed in Standard Chartered and HSBC this week. Net interest income, non-interest income, low loan losses, strong capital, high returns on equity. All these things are sort of are coming through now. And the banks are generating capital over and above what they need from a regulatory point of view. And as a result of that ability to generate surplus capital, that capital is being returned to shareholders through share buybacks and through dividends. And the banks are normalizing now, their returns are normalizing, and they look to me like fully sort of recovered businesses. And that's why I think they are enjoying such a sort of a purple patch right now.
So, Neil, if you had to name one area or one sector that looks genuinely mispriced right now, what would you say?
What, global equities or sectors within the UK?
Any sector, any geography. One area that you think, if I say to you, you can pick one sector that's fundamentally mispriced right now, what would you pick?
UK equities.
I could have probably guessed that answer before I even asked the question. Okay, and if I push you one step further, which sector within UK equities would you look most closely at?
It's a bit of a toss-up. Can I have two?
I'll allow it. Yep.
Okay. Banks and house builders.
Okay. Not a surprise to hear the two that are probably the biggest exposures in the all-rounder strategy. If you had to choose one word to describe financial markets in 2025, what would that word be?
Good.
Excellent. Very insightful, that last one. Good. Thank you, Neil, as always, for your insights. Always great to hear what you think about things as they're happening. If you've enjoyed this conversation, make sure you hit subscribe. It really helps more people to find this podcast. And if you want to go deeper, you can see all of Neil's strategies, the stocks within those strategies, as well as his monthly commentary at w4pz.com. You'll also find the link in the description down below. That's it from us for this week. We will be back with more next week. If you have a question for us, by all means, leave it in the comments. Otherwise, until then, we'll speak to you next week. Take care.